Treasury yields had a busy week and saw yields move higher from last Friday's close. In fact, we saw yields rise north of 4.5%. Then we saw on Friday a shift slightly lower, closing at about 449. So we're still hovering around that level at the highest weekly close we've seen since going back to November. But a lot happened this week. We had very high inflation data. We had some poor demand auctions that helped push yields higher. Then throw on top of that Fed rate cut expectations being pushed out to September. And it looks like the market right now is still trying to get its sea legs back under it. A lot going on geopolitically. We saw risks coming across the headlines in the Middle East that helped a little bit of a flight to quality to take us off those high yields. But again, closing at the highest level we've seen on a weekly basis since going back to November, just below 4.5%. Now, what does this mean for volatility? Well, check out that CVOL index over at cmegroup.com, and you will notice that volatility made a big move higher on the week. Yes, as yields move higher, volatility moves higher, but as we saw a pullback in yields to end the week, we did see volatility continue higher as those geopolitical risks continue to run across the headlines. Lastly, let's talk about what we have next week. Next week, we do have some data points to watch. We have retail sales, some manufacturing data, housing, but really all eyes are going to be on Fed speakers, and one in particular on Tuesday. We will hear directly from the Fed chair. Be very interesting to see what he has to say after the higher than expected inflation data we got, as well as the market repricing for Fed rate cuts further out the calendar. So ending this week, a busy week, 10-year note yields did rise 8 basis points on the week, but we're off their highs ahead of next week's retail sales, manufacturing, housing, and Fed Chair Powell.